Hey everybody. Hopefully you're having a good day. Hopefully everything and all your all your questions are getting answered on this channel. I went through the comments section. I'm reading a lot of comments. A lot of people have questions out there. Obviously, we do ratio investing, and ratio investing to most people is completely new. I understand that. So what I'm going to go through, I did some charts. I plotted basically what the potential returns could be for each sector. And I'm not talking about companies per se. I'm talking about the actual commodities themselves. And when we're working in ratios, what a ratio is an asset versus another asset. So the more undervalued an asset is, the greater the potential of reward for down the line. Because when it goes to get to an overvalued state, we already started from a complete depressed state, will eventually move to an overvalued state. And in order for that to happen, there's a couple of things that we need to analyze. And when we analyze this, it can be kind of confusing. So I'm going to try to step through this. And if you get confused, please leave comments in the comments section. So the first thing is we want to identify sectors that are cheap in relationship to gold. Now, that is your supply, demand, and balance. That is the ratio to gold. So what we're looking for is in a commodity's bottom is a very cheap price of that commodity in relationship to gold. Now, gold is a barometer or an index of how much inflation is in the system. So when we go from a commodity bottom, the bottom typically means that prices are low and that we don't have very much inflation because all of the conditions are going to be set for the money to be in other sectors. So all the money is going to pile into technology and the stock market and bonds. Now, at a commodity bottom, the money's not in this sector. It's not in commodities. So the ratios in relationship to gold are going to be extremely cheap. Gold itself is going to be extremely cheap in relationship to other stocks, in relationship to the money supply, in relationship to all the other assets. That's what a commodities bottom is. Now, when this commodity bull market comes, the valuations are going to change quite dramatically for a lot of the other commodities that are priced in relationship to gold. Those ratios are going to compress. And the compression of the ratios is purchasing power against gold. But if gold is going up against stocks or the Dow and S&P 500, either one, that means that gold's moving up against the stocks and that you have massive leverage in the commodities when those move up against stocks because it's going up against gold and gold is going up against stocks, if that makes sense. So the moves can be very dramatic in some of these commodities because of the leverage that you have against gold and definitely against stocks, if that makes sense. So if gold goes up 10 times against stocks or 20 times against stocks, and we're in something that goes up 5 times against gold, then it's 50 times against those stocks of that particular commodity. Now, if you're in a producer of that commodity, it might be 150 times because that's usually a 5 or 6x on the commodity. And if the commodity is 5 times gold and gold went up 10 times against the Dow, it's 5 times 5 is 25 times 10 is 250 times purchasing power against stocks. And that's how you get your purchasing power gains. Now, I put together a spreadsheet mapping out the leverage that some of these very undervalued commodities have against stocks. And I'll show you what those look like. And hopefully this makes sense to you. So first, you're going to lose me. And then second, I have a platinum price projections here. All right. And the thing that you want to look at. So I'm going to first describe the chart And then I'm going to describe what to look at. So we've got price on the left-hand y-axis here, 5,000, 10,000, 15, 20, 25, 30, 35, 40, and so on. And this is the ratio on the bottom, a half, 1, 1.5, 2, 2.5, 3. So what we're looking at is that platinum was priced below 0.5. So that means platinum could only buy a half ounce of gold or less. That is incredibly cheap in relationship to history. It's never been that cheap. Platinum was thrown in the trash, and then the trash was thrown in the trash, and then that trash was thrown in trash. That's how low it was in relationship to history. So what the price projections are, we've got 1, 2, 3, 4 lines here. This is the price at $2,000 gold. This is the price at $5,000 gold, $10,000 gold, and $15,000 gold. Now, if you notice, when the ratio compresses and we jump up the series, these are different series. So this is a $5,000 gold. This is $10,000 gold. What I want you to notice that when gold increases and the ratio compresses, this was moving to the right. That's a compression of the ratio. When this compresses, or you could say expands, depending on your outlook, when it comes up, it'll jump these series as gold goes up. Now, if gold goes to 15,000 and the compression of this ratio goes all the way to 3, platinum would be at $45,000 an ounce when gold's at $15,000 an ounce itself. So that's the leverage. See how this thing moves up? It would move up like that. And you can see the steepness here, and that's basically the potential return given the price of gold. So the more gold goes up, the more platinum could potentially go up and compress its ratio against gold. And it may not compress it. It may stay somewhere over here. Maybe it only goes to 15,000 when gold's at 15,000. Who knows? Now, these are red. This is uranium, and this is red from the right-hand side to the left-hand side. So platinum was extreme undervaluation. Uranium is at very extreme valuations. We're at 62 to 1, roughly. So we're at 60 to 1. That's what I plotted. And this one's red from the right-hand side to the left-hand side. Now, this is at 2,000, 5,000, 10,000, and 15,000 ounce gold. That's what these series are. Now, if we go to the right and it compresses, and at the top of a bull market, it may compress all the way to 5 or 3. And if you notice, if it compresses that much, it really starts to go vertical at the end. And that's what we see. So if gold goes to 5,000 and it compresses down to 5, that means that uranium would be at $1,000 per pound. I know that sounds absolutely ridiculous, but that's what history has given us time and time again. Every single bull market in uranium was that price against gold. So this is where it would be, somewhere on this scale. So this has massive leverage to the price of gold. Uranium does. And we have massive deficits of uranium 5, 10, 15 years out. So I could see this really starting to compress maybe 10 years out, maybe 5 years out. But it's going to go up quite a bit. And if gold goes up, you have very good leverage to gold in uranium. Now looking at oil, again, this one's red from right to left. When I did this, it was at 50. We're at 35 right now. And we still have a bunch of leverage here. Now, all the bull markets in oil, they usually end at a ratio around 8 or 6 or something like that. So that's really, this is at 5. That's where I stopped. So it would come all the way and it would kind of zoom up at the top here. So if gold goes to $5,000 and it kind of comes up to almost a 5 ratio, that's like $700-800 a barrel. I know that sounds crazy. It's almost in disbelief. I get it. But you know what? Every time in history under commodity bull markets, this has happened. So you being in disbelief would actually be the anomaly if this doesn't happen at the end of the bull market. And here's $10,000 gold, which is a high probability. And it could be $1,700 a barrel of oil. That's what history has done every single time in a commodity bull market. And this is natural gas. Natural gas has some very large leverage. It goes vertical. And I would say this one probably has the highest leverage of all of them, is the natural gas commodity. Now, that doesn't mean that you should just pile into natural gas. Natural gas is a complex beast. It depends very highly on weather, and it depends very highly on hurricanes and all these different things. So past data, you could have had a commodity bull market and had hurricanes, which we had in the last one, which really drove the price of natural gas up. It could potentially happen again in the future. So I think this has incredible leverage, and this is not per 1,000 cubic feet. This is per million cubic feet. So the pricing is a little bit different than what you're normally used to. But look at the compression that we can see. That's what's important. And rather than saying, what's the most, I would say out of all these that I see, the silver price and platinum price, they have good leverage to gold, and they're definitely better than gold in a commodities bull market. But what I want to say is they don't have nearly the leverage as uranium, oil, and natural gas. And the way that I play this is if you have a very low risk way of playing something that will go up and you have good returns, we'll call that physical precious metals. I take the bet, and I take the bet in a big way. So physical silver, physical platinum, they are leveraged to gold, and gold is going to make very good purchasing power gains against other assets. So I'm leveraged to gold for that increase. I think that platinum and I think that silver are very two good plays to play physically, like physical metals, like take delivery of it. Because you have high risks of the dollar having problems, currencies, around the world doing stupid stuff. And that's one way that you can protect yourself in that scenario. So it's a way that you can get leverage and protection at the same time. I'm all for that. So that, I think, it has a place in the portfolios. Physical silver, physical platinum. Platinum is so dang cheap. I had to personally get some. I mean, that's like you got to get some in the portfolio. That's at least my mindset. That's not advice. That's just my mindset. Now, uranium, oil, natural gas, some of these guys, they have massive leverage. Massive. They showed this in history, and the leverage is so great that I think you should play all of them. I don't think you should limit yourself to one sector or two sectors, and I don't think they're all going to happen at the same time. They're going to happen in different time frames, and if you put and spread out a lot of money in all of the different sectors, it will really smooth out your returns and your portfolio and volatility. It'll do a whole bunch of good for your emotional stability as an investor. And keep in mind that just because a sector is going to go up a lot doesn't mean that all of the companies in that sector are going to do fantastic. What I think you'd want to do, and this is what I'm doing, you can take whatever information you want and employ it to your portfolio. But I try to find the best companies in all the sectors. If I know that silver is going to kill it, I want to find some good silver companies. And then I buy some silver companies. And then I buy some uranium companies because they have great leverage to the price of gold in a commodity bull market. Then I look at some fertilizer companies. Then I look at some oil companies. I look at some natural gas, and I spread it out amongst small cap and maybe a couple mid caps at the largest. That's remember, this is me and my speculative money, which is not a big percentage of my portfolio. And I go after the ones at least going after triples and home runs. I'm not going after base hits. I'm not looking for 100% or 200%. I'm looking for at least 10, 20 times the money at a minimum. I want to go after 50 baggers, 100 baggers. I want to go after the big boys and the big returns, I should say. I'm not looking for 3 times my money. I can make that easy. I want big returns, and I don't care about the risk. I can lose some of this money. Doesn't matter because I'm not putting up all of my money here. Now, the low risk stuff is my precious metals. It's my ratio analysis where I'm swapping metals between different metals, increasing my ounces over time. That's a super low risk way that I can play with a bunch of money that is reliable, low risk, and easy to do. Now, if I'm going to push my technical analysis button and I'm going to go for it, I'm going to go for it. I'm going to go for it big. There's the risk in my portfolio is probably pretty great, but that's how you play it if you have a good betting strategy or investing strategy, is to spread the money out into asymmetric bets when they're the cheapest they've ever been and swing for home runs. Because if you just hit a couple of these balls out of the park, if you just hit a couple, 100 bagger will change your entire portfolio with $1,000 going to 100 grand. Or if you put 3,000 in it, it goes to $300,000. That's a 100 bagger right there. Now, if you got 1,000 bagger, $3,000 turns into 3 million on 1,000 bagger. Now, you have to be able to hold on to that. I mean, holding on to it that entire time is going to be rough. It's going to be very rough. Now, the opportunities are out there. You can find them in the sectors. If you guys want to scan the companies, and I scanned a lot of these companies, I do a lot of technical analysis, and technical analysis can give us a little bit of insight on how powerful a company can be and which ones could potentially return 100x, 200x, something like that. I can help everyone on the channel look for these companies. I've got some of them out there, I think. But if you guys have suggestions, leave them in the comment section. Let me know what you like. You know, what are some good oil companies that you really like? What are some good uranium companies? And if they're still down, maybe there's the high cost shale producers that survived. Put them in there if you think you see a good chart pattern. Say, hey, look, check out this company, and I'll check it out and I'll share it with the entire channel. If the chart pattern looks good, I'll share it. So this is my opinion only. This is not financial advice. I think that uranium, oil, natural gas probably have the highest leverage. And then all of the metals are not going to have as much leverage to the price as those sectors. So that would be silver, that would be copper, that would be other platinum and other base metals. There are some base metals that have good leverage. I think nickel does. I think tin does. I think those two have some pretty high leverage. I don't necessarily know how to play tin very well. There are a bunch of Chinese companies that produce a lot of tin, and there's no way for a lot of us to really invest in those companies. I do think the rare earth metals, I think there might be some in that. Definitely, they've got some really large moves coming up. And if we have electric vehicles, there could be some killer rare earth metal investments. And I think the charts would be as good or better than all of these. So if you guys know some rare earth metals, put them in the comment section. Let me know what you got. I'll probably get some money into some of them. Appia Energy is one of the rare earths that I own. The chart looks very compelling. It looks very good right now. So that's a couple. But let me know what you know. Put it in the comment section, and I can check out some of these companies. Give me a thumbs up if you like this content. Subscribe to the channel if you haven't. And thank you for listening. This is Finding Value.